Hey everyone, and welcome to This Explainer. I am super excited to be your guide today as we dive into one of the absolute most popular and honestly most misunderstood technical indicators out there, the Relative Strength Index, or RSI. If you've spent any time at all looking at stock charts, you know the one. It's that squiggly line tracking momentum right at the bottom of your screen. But here's the crazy truth. Most beginners are taught to use it completely wrong. Today, we're going to fix that. We are breaking down expert insights to totally transform how you use this tool, taking you from those classic beginner traps all the way to some really advanced trading setups. All right, let's get right into it.
So, here's our quick roadmap for today. First, we'll cover RSI basics and myths. Then, we'll look at the 60-40 range strategy. After that, we're jumping into RSI divergence, and finally, we'll wrap up with target and risk management.
Starting off with Section 1, RSI Basics and Myths. Let's get a really solid foundation set here.
Okay, so RSI, it stands for Relative Strength Index. And the absolute key word you need to remember here is that it's a lagging momentum indicator. What it does is calculate the average gain divided by the average loss. And usually it does this over a default 14-day period. Because it's lagging, it's taking past data to show you the current strength of a trend. It's not a crystal ball. It doesn't predict the future. It's just showing you what the price has already been doing. It's totally up to you, the trader, to make the prediction based on that clue.
Now, let's tackle the single biggest trap in technical analysis. The classic textbook myth is that if the RSI crosses above 70, it's overbought and you literally have to sell immediately. Or if it drops below 30, it's oversold and you just blindly buy. Guys, please do not do this. In reality, an RSI over 70 just means the buyers are flexing. They are incredibly dominant and the trend is super strong. It really just means you should be a bit cautious about starting new long positions and maybe start thinking about booking some profits. On the flip side, an RSI below 30 means selling exhaustion is getting close. You should be waiting patiently for a proper entry setup to form, not just blindly trying to catch a falling knife.
Moving right along to Section 2, the 60-40 range strategy. Let's talk about why those traditional 70 and 30 levels actually need a modern upgrade.
So the pros? They actually redefine their RSI zones by shifting their focus directly to the 60 and 40 levels. Think of it like this. If the RSI is consistently hanging out above 60, maybe dipping down to it and bouncing right back up, you're in a super bullish zone. That trend is a powerhouse. If it's bouncing around between 40 and 70, you're in a standard bullish trend. But if the RSI is trapped between 30 and 60, well, the bears are driving the bus. And if it's struggling to even peak above 40, that's your super bearish zone. Reframing it this way just gives you such a better, more accurate pulse on what the market is actually trying to do.
But what happens when the indicator just gets kind of stuck in the middle? When RSI is just ping-ponging back and forth between 40 and 60, the price is almost certainly just chopping around sideways in consolidation. For most traders looking for a clear direction, this 40 to 60 zone is a strict no trading area. Seriously, just sit on your hands. You want to save your capital for when the RSI decisively breaks out of that box, because that's what signals a real tradable shift in momentum.
All right, Section 3. What is RSI divergence? This is my favorite part because it's how you spot trend reversals before they even happen. Okay, I want you to picture a speeding car on the highway. If the driver realizes they completely missed their exit and needs to pull a U-turn, what is the absolute first thing they have to do? They have to hit the brakes, right? They got to reduce their speed. They are still moving forward in the same direction for a moment, but their forward momentum is dropping fast. The market does the exact same thing. The price might still be inching up, hitting new highs, but the RSI, the actual momentum, starts dropping. That right there, that's divergence.
Let's break down the two main types so you know exactly what to look for. First up is bearish divergence. This happens in an uptrend. The price action is making higher highs, but the RSI is making lower highs. They're totally disagreeing. The momentum is slowing down, signaling a potential U-turn to the downside. Now, bullish divergence is the exact opposite. The market is in a downtrend, price is making lower lows, but your RSI is suddenly making higher lows. The sellers are exhausted, they're hitting the brakes, and a potential move up is probably right around the corner.
Now here is a golden rule straight from the pros. How long should a divergence actually take to form? The magic window is 3 to 10 candles. Shorter, tighter divergences are just significantly more powerful. If you're looking at a divergence that's dragging out across, say, 30 or 50 candles, it's just diluted. It's lost its edge. You really want to see the price and the RSI disagreeing sharply within a compact window of 3 to 10 candles.
That tells you the U-turn is imminent.
I absolutely love this next point because it completely goes against what a lot of standard textbooks tell you. Most people think you should only look for divergences at the extreme edges, like 80 or 20. But a major pro tip is that the highest conviction divergences often happen right near the 40 and 60 RSI levels. A bearish divergence forming right at the 60 resistance level or a bullish divergence forming at the 40 support level, that is a powerhouse setup, mostly because it perfectly lines up with those zone rules we talked about earlier.
Okay, Section 4, Target and Risk Management. Because spotting the setup is literally only half the battle. Now we have to execute.
So how do we actually know where to take profits? We use a super logical ABC method. First, you just identify point A and point B on your chart. Those are the two peaks or valleys that actually make up the divergence. Next, you look at the price action right in between those 2 points. Find point C. That's the lowest valley between two peaks in a bearish setup or the highest peak between two valleys in a bullish one. That point C, that becomes your exact mechanical trade target. Once the price hits that level, the divergence has done its job and it's time to take your money off the table.
But hold on, before you actually enter the trade, you've got to run through this professional checklist. First, don't jump the gun. Never anticipate the turn. Always wait for a confirmation candle, like a solid red or green candle proving the reversal is actually happening. Second, put your stop loss just past that recent high or low. Third, and honestly this is the secret to long-term survival, make sure you have a minimum risk-to-reward ratio of 1 to 3 or 1 to 4. And finally, never ever trade on RSI alone. Price action, support, and resistance, they are always king.
Wow! Okay, we have covered a tremendous amount of ground today. We went from completely redefining the standard RSI zones to actually spotting those hidden momentum shifts before they happen. So, I want to leave you with a challenge. Go pull up your favorite stocks chart right now. Are you still stuck in that beginner 70-30 trap, or are you finally ready to start spotting those hidden U-turns before the rest of the market even has a clue? Thank you so much for hanging out with me on this explainer. Keep learning, keep practicing, and I will see you in the next one.